Hello and welcome to yet another edition of Taking Stock, and I'm here at the beautiful Motilal Oswal headquarters. It's always lovely to be here, and of course, as you can see, there's that bull that is always charging here at Motilal Oswal. And I have two special guests joining me now. We have Manish Sonthalia, CIO of Motilal Oswal PMS, and of course Aashish, the MD and CEO of Motilal Oswal AMC. Gentlemen, good to have you on the show. Manish, let me start with you. First of all, your ad is really good, right? You focus on one thing, you master it. At Motilal Oswal, of course, you say that you have mastered equities. Do you think what's happening right now is the Indian investors just focusing on equities because no other asset class is working? And is that explaining the kind of bull charge that we're seeing right now?
So, nobody has mastered equities. We are also learning on a daily basis. But there is a shift from physical savings to financial savings. I mean, that is there. Yes. And it is across asset classes within the financial savings sphere. So whether it be insurance premium, whether it be bank deposits, whether it be equities, everything and anything to do with financial savings is on an up move. And obviously equities is a part of that. We are seeing record domestic inflows, and it's not going to stop anytime soon.
Manish, are there any warning signs right now? And I discussed this because today we had advance decline ratio of 1:2. We've recently seen all the recent listings, AU Small Finance Bank, for example, where I believe in the past Motilal Oswal has also had a positive view, surge, and go to market cap of 20,000 crores. We've seen stocks like CDSL, Hoodco, just continuing to rally on. Today we saw some bit of decline in some of these stocks. Are there any warning signs right now on what's happening, especially on the retail side?
Also, one thing is very clear. There is froth in the mid-cap and the small-cap space. And this is not only true for the recent listings. As a genre, as a area where equities are, it's in a froth zone. And you will only make money if you have a slightly longer-term time horizon. But coming to the point regarding listings, if you have so much of interest, getting catapulted due to margin funding, etc., and you have 500 times subscription, 200 times subscription. I mean, all that adds to the cost, and there is froth in the short term. But that is not to say that these businesses don't have value. It is how long you can wait to see genuine returns coming from the stock, apart from the short-term pop in the markets on account of listing. So, yes, there are excesses, but if you have a slightly long-term horizon, there's still money to be made on the table.
Okay, still money to be made. It was a good week actually for the market because you had the Sensex and Nifty gaining over 2%, the Bank Nifty gained over 2%, Nifty Junior was up over 2%. The mid-cap and small caps underperformed, which a lot of people believe was actually a healthy sign for the market. So let's see, where things go from here. Also, what happened was that this week we saw a big run in some of the pharma stocks. Reliance has been holding one end up, so things looking good. Aashish, your thoughts on the kind of money you're getting at your stable SIPs? Are we at record levels in terms of SIPs and in terms of lump sum investments, even at record levels?
Oh yeah, absolutely. I mean, these are pretty much all-time highs. So if you look at the SIP levels, my sense is we are at about 4,800 crores of inflow per month, and rising by about 150 crores every month incrementally. So that's at a record. If you look at the industry net flows, a lot of times what happens is what gets reported is the equity net flow. So take for instance, in the month of June, you had about 8,200 crores of equity net flow. But what goes unnoticed is that almost an equal number is coming in the balanced and dynamic kind of category. So that was another 7,800 crores. And in that 7,800 crores also, about 60-70% gets into equity. It depends if there is a corresponding short position and those kind of things. But my sense is that 14 to 15,000 crores of net flow into equity and equity-oriented products is all-time high. In my experience.
So is that presenting a risk, for example, for you as well? You guys run a very concentrated portfolio, right? 7 or 8 stocks would account for 80-82% of your fund. I mean, it could be, 2 or 3% here or there. So in that sense, is it tough to sort of maybe top up in some of these stocks or, find new stocks if you keep getting this kind of money?
So, of course, the concentration and number of stocks could be different in the PMS and the mutual funds and the alternate funds.
Yes.
But if I take an example of, say, mutual funds, then top 10 stocks could be anywhere between 50 to 60%. Let's take an example. So, the point is that typically if you see mid-cap would have a different set of dynamics. A large-cap fund would have different set of dynamics and multi-cap fund would have different set of dynamics. That is one. Second important thing to really keep in mind is that we are running, focused portfolios with 20 odd stocks. So we're not really, in that sense, I would say there is concentrated and there is focused and then there is diversified and then there is like, I would say hugely diversified kind of thought process. So we, as a house, I can answer this more as a house rather than the market. As a house, if we really think that there are capacity constraints, we would rather take a call on the capacity than going crazy in terms of the size or compromising the mandate or compromising the level of focus. So we are ready to review the capacity and review the inflow rather than reviewing the other areas.
Okay. Manish, let's talk about some of the big talking points this week. One of them was the way pharma stocks rallied, Aurobindo Pharma in particular and Biocon. Do you have any exposure to pharma sector or any of the stocks that I mentioned, and as such, your call on the space?
So the call is bullish on the space. I mean, we are somewhere very close to the bottom as far as the pharma space is concerned. We don't have the specific two names which you mentioned, but we have a Sun Pharma where we are quite positive, even though the stock has not really done too well because of regulatory constraints. But I think remediation for the US FDA problems is all underway. It's a matter of time when you should start to see growth. We saw two problems come together. First is the clampdown on LEM, NLEM. Then you had the US FDA problem. Then you had the GST disruption. All of that has got factored in. Now we have come to such a point that valuations are forecasting something like a single-digit sort of a growth. I mean, single-digit. The Indian pharmaceutical market is supposed to grow at 10% plus. On top of that, the US market. Of course, there will be pricing pressure, but the volume growth is going to be there. It will come at a lower margins. All of that is there in the price. My sense is, if you take your picks, I mean, any of them which you want to, there is money to be made, provided you have some patience.
Okay, Aashish, on IT, we had the numbers today, of course, from both TCS and Infosys. Anything that tells you that the worst is over, or is this space going to remain an underperformer?
I think I wouldn't make a comment on underperformance vis-a-vis the index really if you ask me, but yeah, from perspective that as far as our style of investing is concerned, since for us, the kind of 18-20% growth is like what we really look for. In my own experience, in all these years, these are one of the few times I am seeing that most portfolios are either zero IT or underweight in IT. And so from that perspective, I think that growth is a challenge. And these businesses are trying to reinvent themselves. So that I think is one area to really watch for. I mean, a lot of times what I've also seen, since you were talking about pharma and it's related to US and Donald Trump, I've also seen people kind of hyphenate IT and pharma. So pharma Manish has clearly spelled out the different dynamics. IT, clearly, I think there are business model challenges. Okay. And as we speak right now, they are not stacking up on our growth expectations, what we look for, including in our portfolios.
Okay. Manish, if I'm not wrong, sometime back you had taken a large call on Infosys, if I'm not wrong, or you're not backing that at all?
I didn't have a position in Infosys. I still maintain a position, but albeit a small one in TCS.
In TCS? Yeah. So, and TCS has outperformed Infosys once again over the last 3 months or so. Are you still backing it, or you think?
Yeah, I'm still backing it. I mean, as I said, as in the case of pharma, if you're looking at large cap IT companies trading at maybe 14.5, 15 times FY19 earnings, is more or less signifies a 0% sort of a growth, the valuations, because your 10-year GSEC is around 6.25. So I think there's still growth out here. If you take from a 1-year perspective or 2-year perspective, we are still talking about growth. We're not talking about degrowth. So these are stocks which are representing hardcore value. And on the one side, you have a huge momentum in the market, where stocks are trading at 100 Ps and above.
Yes.
So there are two contrasts.
Yes.
So we have to balance both of them.
Yes.
So,
which is what my next question was. How do you approach this market? Because, on one hand, you have had stocks like Eicher Motors, Maruti, so many stocks which keep making you more money, but which every time you look at them, you say, these are so expensive. On the other hand, cheaper stocks have remained cheap. So how do you take that call between value and growth?
So we are not contrarian investors, and we are not deep value investors. We are growth investors.
Yeah.
So,
But growth at a price, right?
yeah, we are growth at a reasonable price, not growth at any price.
Yes.
It's not GAAP, it's GARP.
RP, yes.
Yeah, so, so that's a conundrum. So whatever stocks we have in the portfolio, we think that the growth is still there to come, which has not yet been priced. On the one hand, there are stocks which are so mispriced by the market that even normalized levels of growth would mean that you would not lose capital and you would make some decent capital from it.
Okay. Aashish, what are the risks for this market? Are they largely domestic in nature or are they global in nature? Because, this market has seen so many perceived negative news flow domestically and has moved on, whether it was demonetization, disruption due to GST. The market doesn't care. So are the risks local or global?
I think that, if you really ask me, one of the things which definitely I do worry about is that, because there is a huge amount of flow, right? And in this flow, there are clearly two things. One is people who have good experience of investing in the past and they are increasing their exposure, right? And second is at the same time, there are a lot of new investors come in. So according to me, when you look at risks, for me, what is risk is that, there are a lot of new people coming in. What kind of experience will they get? Are they coming with the right side of expectations? I want to just give you one example. Recently, I met a client and he asked me something about, this typical Maruti ads like Kitna Degi, that type of thing. So I told him that, from these levels, next 3 to 5 years, let's say index should give you more like, 12% or something like that, a slightly conservative number. So he said, this much return debt gives. I said it used to give. I don't think even debt is giving this. And inflation which was 6% is settling at 3-4%. The 10-year bond which was always at 9 is settling at 5.5, 6.5, right? So why should equity give you 18-20%? I mean, that number also, the real return might be maintained, but nominally you have to look at lower numbers. Plus interest rates going down has re-rated P's, so from that point on. So one of the risks for me is that the flow is thick and fast, and if there is any shock to the market, we will give a bad experience to a lot of investors. Would they panic then? I definitely do worry about it, right? So I would be happier if the market just didn't keep going one way up and people just didn't, I would be happier if the market kind of consolidated at some point in time. People kind of, got comfortable with the whole thing. That is one. Second is there is always a risk of continued disappointment, when you mentioned about earnings. Because every time we look forward, some or the other accident comes up. Sometimes it is China and the commodity markets and oil. Sometimes it is asset quality review. Sometimes it is demonetization. So, I hope that there are no more accidents and people have a good experience for some time.
Okay. Manish, the other talking point this week was, what's happening with the oil marketing companies and with the oil and gas space in general, whether there's that merger happening or not. Are you still bullish on any of the oil marketing companies? In the past, if I'm not wrong, you have been bullish on HPCL. Still holding?
We have HPCL and BPCL, both of them.
Okay.
We have taken some money off the table from HPCL in one of the portfolios.
Okay.
And this has a lot to do with the expansion plans, because a whole lot of capex is about to come. On the other hand, you have a super cycle in the case of GRMs, and marketing margins because of dynamic pricing should also go up. We are talking about a situation where you had inventory gains and which gave you 43% ROE in the case of HPCL. Going forward, whether those sort of ROEs are possible or not possible, because inventory losses and gains are not to be seen in the case of dynamic pricing. What is a normalized DPS? My sense is in the case of HPCL should be something like 60-62 rupees and a huge capex, which means dividend payouts are not going to be lucrative, what we have seen in the past. So, and on the other hand, you are paying a 5-7p sort of so I think there won't be any free cash flows, a lot of operational cash flows, and that is why the P multiple should not get re-rated very massively. That was the main reason for truncating some of the allocations in HP. We still maintain some allocation because valuations are extremely cheap. We also like BPCL. It is more of a structural play, and none of the the merger and acquisition sort of things is working around with BPCL. So we are having full allocation. We still maintain a positive stance on most of them.
Okay, last question, and I'll take short answer from both of you. Nifty is about to hit 10,000. You still buy at 10,000. This is still a bull market where you buy at 10,000.
So we are fully invested at all points in time, whether 9,000 or 11,000,
Yes.
and we are at 10,000. But what I can say is that there is a correction which is overdue.
Okay.
Sooner it comes, the healthier it will be for the market.
Okay. Your thoughts?
See, I think that people have been waiting for a correction too long, right? And my estimate is that out of 6 lakh crores lying in equity mutual funds, approximately 70 to 75,000 crores is lying in cash waiting to be invested.
Okay.
So I think that, I actually concur with Manish, because a lot of people have been, really waiting, and people are getting nervous.
Okay, gentlemen, thanks a lot. Always good talking to you. Thanks a lot for, inviting us. And that's, of course, first half of Taking Stock. That's the market fundamentals. We'll come back and discuss the technicals of the market with Ashwini Gujral.